taxes. I'm pretty sure a lot of you probably get annoyed when you hear this word, especially if you're from a country with a government that squanders billions of public revenue due to corruption. We always want to pay less and get more. In this video, we will be talking about what that looks like. This is World IQ. Let's get it. The government will tax you for every profit you earn from your business, regardless of where you are. That's just a way for governments to create revenue for public funds. However, there is one country in Europe that has set the precedent for lowering corporate tax rates: Ireland. Before we explain why Ireland has competitively low corporate taxes, let's first explain some key concepts in this video. First, what are corporate taxes? According to Investopedia, a corporate tax is a tax on the profits of a corporation. Taxes are paid on a company's taxable income, which includes revenue minus the cost of goods sold, general and administrative expenses, selling and marketing, research and development, depreciation, and other operating costs. So it's tax for whatever money the business makes. Second, what are foreign direct investments? The Organization for Economic Cooperation and Development defines foreign direct investments as a cross-border investment in which an investor resident in one country invests in another. A key feature of foreign direct investment is that it establishes effective control of the foreign business, or at least substantial influence over its decision-making. Think of it as Apple investing in Ireland to put up their European headquarters. The Irish government in the 80s was looking to restructure its economy from agriculture and fishing towards the software and pharmaceutical sectors. They had a similar culture with the United States, and this caught the eye of American multinationals to set up their subsidiaries in Ireland. They wanted to attract foreign direct investment, so they started to decrease the corporate taxes. They started it between 1995 and 2004. Their tax rate decreased from 40% to 12.5%. This whole restructuring of the tax system was ultimately beneficial to Ireland because in 2012, the Irish government made a whopping $135 billion in gross profit from American-owned subsidiaries. As a result, in 2015, Ireland had the second highest GDP per capita in the EU after Luxembourg. Talk about money, huh? While it may look great on paper, it makes us question, why not all the other countries just do this thing? Well, it's not that simple. The world of international political economy is complex with a lot of factors to think about. It's not all positive for Ireland, it also has its fair share of drawbacks. Some stakeholders benefit from the policy while others are put at a disadvantage. It fosters a culture of tax avoidance that compels other smaller enterprises to follow suit. Even if Ireland has greatly benefited from this, economically speaking, their reputation as a trusted international partner might deteriorate because of this policy. Their national economy is now dependent on its ability to attract multinationals. To maintain clients and to attract more, they've been found guilty of bending the rules. The Apple scandal is one of the most prominent examples. In 2016, Ireland's corporate tax rate was under fire. Apple is one of Ireland's biggest clients and one of the greatest users of offshore accounts. They do this because they want to lessen the tax liabilities in the US. Fearing that Apple would relocate their headquarters and take thousands of jobs with them, they kind of made a special and illegal exemption for the American giant. Throughout 2014, Apple only paid a corporate tax rate of only 0.005%. The European Commission ordered Apple to pay 13.9 billion euros in fines back to the Irish government. However, in 2020, the EU's General Court said it had annulled that decision because there was insufficient evidence to show Apple broke EU competition rules. Yes, Apple made a sigh of relief when that court ruled in favor of their appeal, huh? Another example of such scandal would be the Pfizer-Allergan merger. If you're unfamiliar with those names, they're both pharmaceuticals. Long story short, Pfizer is a big pharmaceutical company and it wanted to lessen taxes and increase revenue. To do that, they were acquired by a much smaller Irish company called Allergan. That would then make the move to relocate their New York headquarters to Dublin legal. If you think about it in money terms, Pfizer would earn 1 billion euros in revenue, while Ireland will earn 620 million euros in annual corporate taxes. It stirred such controversy since the corporate deal would consequently mean the loss of jobs in one or both countries. For Pfizer, the added revenue would fund further research and development for illnesses such as cancer. But if you think about it, they have no legal obligation to stand by what they said, and the incentive for mega firms to continue research diminishes. The future of the Irish tax system is both certain and uncertain. Certain because the Irish government will continue to protect and implement the low taxes. They want to keep the jobs there. It is so sacred as well that even in the European debt crisis of 2010, Ireland did not raise taxes. Instead, they cut the minimum wage and social safety net to implement austerity measures. It's uncertain because the international pressure to establish a 15% global minimum tax rate might cause problems for Ireland in the future. I mean, it makes sense other countries would want to abolish the so-called tax havens because it creates an unfair business opportunity. It has started to gain traction that 130 nations are in the works to make the global tax system a reality. If that were to happen, Ireland would lose its biggest leverage against other countries. Of course, multinationals will not pull out right away, they have contracts signed, but Ireland and other tax havens would certainly lose that title. If big companies like Apple were to pull out, that would mean people getting laid off and the Irish government losing billions of euros. Furthermore, in 2017, EU member states started working on a list of countries that were going to be blacklisted because they were a tax haven. The EU list of non-cooperative jurisdictions for tax purposes that was adopted by the Council last February are these countries. The European Council argues that the EU is working to promote and strengthen good governance mechanisms to tackle tax fraud, evasion, and avoidance. The list was based on three important factors, namely tax transparency, fair taxation, and measures against base erosion and profit shifting. Alright everyone, that's it for today's video. Thank you for tuning in. I hope we have accomplished our mission of expanding your world IQ. Do you think it's right for Ireland to keep the taxes low? Let us know in the comments. If you like videos that talk about taxes or money in other countries, let us know. Check out our other videos. Want to start a new life? Here's a video of the top 9 countries you can consider.